There are times in capital markets when silence is more revealing than any statement. Today, Lopez Holdings Corporation stands at such a crossroads. A courtroom battle quietly shapes its control, even as the usual corporate routines continue, undisturbed, before shareholders and investors. At the heart of this story is Federico Piki Lopez, chairman and chief executive of Lopez Holdings. News broke that he was removed as president of Lopez Inc., the ultimate parent holding majority shares in LPZ. Yet a Mandaluyong court quickly stopped this move, preserving his leadership, at least for now. Surprisingly, these events unfolded with barely a ripple on Lopez Holdings' official disclosures. Where investors might expect clarification, only ordinary filings appear: stockholder notices, ownership reports, routine paperwork. The contrast is stark: boardroom drama and headlines, business as usual in the public record. Some may explain this silence as legal caution. After all, the disputed actions originated in Lopez Inc., a private parent, not in LPZ itself. Yet, Philippine Stock Exchange rules anticipate such complexities. They require listed companies to disclose any material event that could influence an investor's decision, even when that event concerns controlling shareholders, changes in control, removals of key officers, or related legal proceedings. The rules seek substance over corporate form, transparency over discretion. This is not a trivial family quarrel. Lopez Holdings controls interests in firms like ABS-CBN and First Philippine Holdings. Leadership changes at the parent level reverberate across these subsidiaries, affecting how minority investors price governance risk. The court's injunction didn't just restore Piki Lopez, it reached into the machinery of corporate control, barring moves that would change representation or decision-making across the group. This goes directly to the heart of market materiality. Who votes? Who speaks? Who leads? The expectation of disclosure is clear. Issuers must promptly inform the market, halt trading if needed, and clarify press reports if asked by the exchange. Yet, in the wake of this dispute, public filings remain routine. Another Lopez company, First Gen, demonstrates that the mechanisms for market-sensitive disclosure are active. But here, the silence persists, not just from the company, but from the exchange. Such opacity undermines trust. A market thrives on equal access to information, not whispered narratives or patchwork news reports. If the exchange sees no material impact, let that judgment be public, justified, and tested. If materiality is acknowledged, let disclosure follow, visible and timely. The timing intensifies the awkwardness. A shareholder meeting looms, where shareholders are asked to ratify board decisions and elect directors. Yet, legitimacy in listed markets depends on informed consent. When control is contested so publicly, can shareholders truly ratify decisions without clarity on who ultimately holds authority? No rule violation may be obvious, but a narrow interpretation of what investors need to know falls short of modern market best practice. This episode is a bellwether, a test not just for one conglomerate, but for the disclosure architecture that anchors market trust. For investors, it is a reminder: governance risk is real, and silence and disclosure should never be mistaken for stability. For regulators and exchanges, it is a call to action: ensure that transparency prevails, so that the credibility of the market remains intact. Trust ultimately is the highest premium in public markets, and it is earned, not inherited.